Hi, I'm Bill Spalding. Welcome to WCS Money Tutorials. Today's topic is a quick summary of Dynasty Trusts and how these trusts save wealthy taxpayers millions, maybe even billions, of dollars from taxes. A trust is a legal entity that holds and manages the property of the grantor, who creates the trust. The trust is created when property is transferred to it. A trust is managed by a trustee, who is often the grantor, but may be a corporation or other type of business. A revocable trust is controlled by the grantor and can be changed at any time by the grantor. An irrevocable trust is managed by the trustee according to the trust document used to create the trust. The grantor no longer has control over the trust and is often deceased. The trust document allows the grantor to exercise dead-hand control over the property and its disposition. The grantor defines the operation and purpose of the trust and how the property is retained or distributed through the trust document. All dynasty trusts are irrevocable trusts. A trust is often used for estate planning because it reduces taxes. It gives the grantor greater control over the disposition of the property after their death, and it avoids the time and expense of probate. Probate is the court-administered processing of estates to pay taxes owed by the decedent or estate, to allow creditors of the decedent to file claims for payment, to distribute property according to the will, and to resolve any disputes among beneficiaries. Since the trust owns the property, its assets may be protected against creditors, such as divorced spouses. A dynasty trust, also known as a perpetual trust or descendants trust, is a type of trust created primarily to save on gratuitous transfer taxes over several generations, while also having the other benefits of trusts. Gratuitous transfer taxes collectively refer to estate taxes, gift taxes, and generation skipping transfer taxes. A generation skipping transfer tax, which I will hereafter just call it the GST tax, is a tax that is added to the estate tax on property transferred to a second or later generation. When Congress first implemented the estate tax in 1916, they intended to tax each generation, as wealth was transferred from parent to child. But an easy way to circumvent that was to bequeath property to grandchildren or later generations, rather than giving it to their own children, since they were usually wealthy in their own right. Congress responded by enacting the GST tax in 1986, which is an additional tax on top of the estate or gift tax on any property given to a skipped person, defined in the tax code as someone who is at least 37 1/2 years younger than the donor. However, most people do not pay gratuitous transfer taxes because of a very generous unified tax credit that can be used to offset these taxes. As of 2024, the unified tax credit allows individuals to transfer $13.6 million of property to heirs without incurring any federal taxes. A couple may transfer double that, or $27.2 million, without federal taxation. This value is indexed for inflation, but this recently doubled credit will drop to half its value in 2026. Since the primary purpose of dynasty trusts is to save on estate and GST taxes, these trusts are mostly useful for people whose estates exceed the unified tax credit. Irrevocable trusts, such as dynasty trusts, are separate taxable entities, so the trustees must file their returns annually. This is how dynasty trusts work. Without estate planning, when each generation dies, their estate would have to pay an estate tax on the transferred property. So by the fourth generation, the estate tax would have been paid 3 times, as illustrated in the first column in this diagram. If the first generation tried to save on estate taxes by transferring property directly to grandchildren or later generations, then they would have to pay both the estate tax plus a generation skipping transfer tax on the transferred value. Both tax rates equal 40%, which would yield a tax almost as much as the value of the transferred property. The dynasty trust saves on both estate and GST taxes by owning the property, then paying out the income earned by the trust to beneficiaries, or to allow them to use the property such as real estate. The estate tax must be paid on the transferred value to the dynasty trust when it is first created, and the GST tax will also have to be paid when the trust finally terminates, since the beneficiaries will be more than 1 generation removed from the grantor of the dynasty trust. However, no other estate or GST taxes will be due as long as the trust exists. Most of the legal requirements of trusts and how they operate are governed by state law, so the state in which the trust is located determines the asset protection provided by the trust and the term limits of the trust. But federal taxes are the primary taxes on trusts, so estate planning to save taxes depends on federal law. States may also tax trusts. However, there is competition among states to attract as many trusts as possible, so states that want to attract trust business do not tax trusts and offer more flexibility in managing the trust. In previous years, the terms of trust were limited by the rule against perpetuities, but many states have abolished the rule or modified it to greatly lengthen the allowable terms of trusts. The uniform statutory rule against perpetuities, which some states have adopted, permits a trust to last at least 90 years. According to the Pandora Papers, South Dakota has the most trusts because the state does not tax trust income and there are no term limits on trusts, so dynasty trusts can last indefinitely. The Pandora Papers was a leak of almost 12 million documents that revealed hidden wealth, tax avoidance, and in some cases, money laundering by some of the world's rich and powerful. Dynasty trusts are an effective way to hide assets and to protect them from creditors, which is why the very wealthy use them so often. Trusts do have some disadvantages, including a high tax rate on low incomes and the dilution of wealth through successive generations. Moreover, the beneficiaries do not receive the full benefit of the value held by the trust, since they mainly receive income earned by the trust and the use of some property, such as real estate. As you can see from these two tax tables for trusts for the 2024 tax year, trust ordinary income is subject to some of the same marginal tax rates as individuals, but at much lower incomes. For instance, ordinary income above $15,200 is taxed at the highest tax rate of 37%. Capital gains are also taxed at the same rates as for individuals, but the tax brackets apply to much lower gains. This is why almost all trust income is distributed to beneficiaries, so that it will be taxed at the beneficiary's rate. Another disadvantage of dynasty trusts is that the value of the trust per beneficiary diminishes with each successive generation. If each descendant has 2 children, then by the 6th generation there will be 64 heirs. By then, the value of the trust for each heir, as well as the relationship of the heir to the grantor, will only be 1.6%. Another disadvantage is that both state and federal law governing trusts can change at any time, and change is likely over the long terms of dynasty trusts. Since many people are clamoring for the rich to pay more in taxes, one change that may occur which would reduce or nullify the benefit of dynasty trusts is a federal wealth tax on irrevocable trusts. Some people have questioned the constitutionality of wealth taxes enacted by the federal government because there is a provision in the United States Constitution that direct taxes, which apply only to people, be apportioned according to the state population recorded by the U.S. Census. However, since irrevocable trusts are separate taxable entities, and they are obviously not people, there would be no constitutional problem in applying wealth taxes to irrevocable trusts. Check out my detailed video on the constitutionality of wealth taxes. The link is provided in the description. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials in personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.